Hello everyone, welcome to my channel SBK Questioning. In this video, we will first see the top 5 takeaways from Robert Kiyosaki's book, Rich Dad Poor Dad. This book has been for many years a top-selling book all over the world and gives very detailed ideas about fundamentals of money making. I have tried my best to keep this video short and had to pick many specific lessons from the book. The original book contains around 300 pages. So pardon me if I can't cover everything in this summary. So let's start. Working long hours for little money, clinging to the illusion of job security, and looking forward to 3 weeks vacation a year, and maybe an Al-Qaeda pension after 45 years of hard work. Does it sound tempting to you? If yes, in that case you might don't need this summary. Let's dive in. Insight number 1. Rich people buy assets, where poor people buy liabilities. Which they think are assets. Is your house a liability or asset? If your house is your biggest asset, you're in trouble. If you want to get rich, the most important thing you need to know is that assets will make you rich. I know you're now screaming in disbelief towards the screen. But then why isn't everyone rich? The equally simple answer is that people generally don't know what an asset is. An asset is something that puts money in your pocket, where a liability takes money out of your pocket. Let's look at how a rich person behaves when they earn money compared to a poor person. The rich receive their income and buy assets immediately. They buy assets like stocks, bonds, and real estate. In the long run, these resources will make them more money in the future. The middle class earns their money with a good job, but once they get their salary, they spend it on liabilities which they think are assets. Possessions like TVs, cars, or vacation homes. You may look rich and your friends admire you for it, but you'll never be truly rich. Now you will have a question that, but isn't it risky to get involved in the stock market? What if there's another financial collapse? Many people somehow convince themselves buying an expensive car that's a guaranteed money loser while they think it's stupid to buy financial assets because you could lose money. Isn't it crazy? Takeaway number 2. I suspect you all have heard the story about Robin Hood. You know, the man who takes money from the rich and gives to the poor. Inspired by this fairy tale, the poor and middle class have invented taxes. The rich should pay more taxes to take care of the less fortunate. This mindset punishes the productive people and supports the unproductive. The goal is to create a more equal society where everyone is included. The problem is that the rich people are too smart for the system, and they find all kinds of ways and vehicles to protect their hard-earned money. And in the long run, middle-class people pay more taxes and rich people anyhow save their money from taxes. Rich people are too smart for the system, and they find all kinds of ways and vehicles to protect their hard-earned money. One such vehicle is corporations. Corporations are good for two main things. First and foremost, they allow you to pay less taxes. The biggest expense of the average household is taxes. It's not uncommon for people to work very hard a full year and pay up to 40 to 50% in taxes. Warren Buffett has for many years been in the top 5 richest men on the planet and is known to pay less taxes than his secretary. A corporation allows you to spend before you pay taxes. You're also allowed to deduct VAT from a sale up to the cost of the purchase. So you can actually buy things for up to 50% of the original price. For example, an expensive dinner out with your girlfriend can be office expenses. But I'm just kidding. Don't do that. That would be illegal because the dinner has nothing to do with your company. At least if you get caught. The second thing corporations are good for is protection from personal lawsuits that could have a devastating impact on your personal finances. With a limited liability company, you're protected from such risks, and the downside is limited to the company, not your personal wallet. Imagine you're a gym owner, and some customer comes with a Ferrari to your gym. While he is training in the gym, someone, jealous of your business successes, has damaged the car in your parking lot. The owner of a car decides to sue you for irresponsibility for not having a camera in the parking. You lose in court because of your carelessness, which would force you to file personal bankruptcy if you didn't have a corporation. In the case of a corporation, the lawsuit is limited just to your business. Takeaway number 3. Divert your focus from earning money to making money. In this case by assets. There are two different attitudes. First, study hard so you can get a good job at a great company. And second, study hard so you can find great companies to buy. Author's poor dad had a PhD but was always struggling with money. Where the rich dad didn't even finish high school. Poor dad had got his PhD after many years of hard work and study just to get a few hundred extra in salary every month. On the other hand, rich dad has also worked equally hard to set up his enterprise, and uses those years to start acquiring assets. The rich focus on their asset column while everyone else focuses on their income statement. I find this to be an interesting subject. If the average person were to get a pay cut by 2%, he would be furious. On the other hand, if the cash flow from their assets income goes 2% lower, they won't be so furious. For some people, it's a worse situation to lose 2% of their assets than to lose 2% in salary. Salary levels are taken personally, while asset levels are not. This is a common problem for poor mindset. Start to take responsibility for your investment decisions by improving your assets and reducing your liabilities. Takeaway number 4. Playing it safe versus managing the risks. It's not advisable to take unmeasured risk, but is also not advisable to take no risk at all. Some people put their lots of eggs in one basket and some put their few eggs in lots of baskets. Both are wrong ways to invest. Don't diversify your little money too much. Learn how to manage your risks. There's no reason to diversify your portfolio if you have enough confidence in your research and calculation of the investment. Buying an investment without any research is gambling, and to not to lose money in gambling, people diversify their portfolio a lot. If you want to become rich, you must first be focused. Look at the top richest people in the world. Jeff Bezos, Bill Gates, Warren Buffett, Mark Zuckerberg have become rich not by being diversified, but by being focused. Don't do what the poor and middle class do, which is to put their future into many baskets. Instead, focus and put them in a few. In finance theory, it is argued that diversification reduces risk. But I would argue that risk is a result of uncertainty, which in turn is a consequence of a lack of knowledge. Stay focused and you'll have time to gather more information about each of your investments and in turn, reduce your risk while getting a high return on investments. Takeaway number 5. What is cause of all evil, a love of money? Or the lack of money? Money is a form of power get from financial education. Rich without financial intelligence will be poor soon. This is the reason why the famous and rich people keep getting bankrupt from time to time. Financial education is the reason that the rich get even richer, where the poor get poorer and the middle class struggles in depth. It's because the subject of money is not taught at home or in schools in depth. Many of us learn personal finance from our surroundings. This means that if your surrounding isn't rich already, you need to start reading books on financial education, or just keep following my channel. Robert Kiyosaki mentions a few skills that can help one to become financially intelligent. Number 1 is accounting, ability to read and understand numbers. Number tells complete stories about any business. If you wanna have a video in depth about accounting, please tell me in the comment. Number 2 is investing, the science of money making money. Number 3 is understanding the markets. It is always about supply and demand. Getting a job and salary, selling a product in the market, starting a business, or buying a stock and shares, all rolls around supply and demand. Number 4 is lawsuits. You must learn how to save your money being taken away as tax or as a penalty. Understand the tax advantages and personal protection provided by corporations. Don't be afraid to spend your money on education, which will improve your knowledge and develop skills necessary to beat your weaknesses. You don't have enough time to do all the work by yourself. Spend money on books, seminars and so on. Instead of starting from scratch, take a basic working model of someone and improve it as per your goal. The returns from these investments will be unmatchable. Remember, there is always 3 kinds of knowledge. First, the knowledge you know that you know. Second, the knowledge you know that you don't know. Third and most important, the knowledge you don't know that you don't know. For this you need help from experts. So start investing in yourself. Let's summarize today's video. Takeaway number 1. Don't work for money, but let the money work for you. Takeaway number 2. Power of corporation, the money saving tool against taxes. Takeaway number 3 is to start taking responsibility for your own investment decision. They are even more important than salary advice. Number 4, the focused investment by managing risk. And number 5 is to get financially educated, and don't forget to take help or hire experts to save your time to make more money. Now we know that one should make money instead of working for money, but what are the different ways to make money? Author calls them the quadrants of money making. You will find below the link of a video explaining different ways to make money. It might be the next good video for you to watch. If you like my video, please press the like button. If you don't like the video, dislike it and leave a comment about what you want to improve. I will see you in the next video. Bye.